By the end of this video, you'll know exactly how Warren Buffett finds stocks worth buying, and more importantly, how you can use his framework starting today. And the last principle I'm going to share. It's the one Buffett himself says made him billions. So grab a drink, get comfortable, and let's dig into how the Oracle of Omaha actually thinks about investing. Warren Buffett bought his first stock at 11 years old. He spent years learning everything he could about investing before he ever made a real dollar. By 19, he had read every single book in the Omaha Public Library on stocks and bonds. Every book. Think about that. Most people download a stock trading app and start buying within 24 hours. Buffett spent a decade studying before he committed serious money. And here's what he learned from his mentor, Benjamin Graham, at Columbia Business School in 1951. 3 principles that still guide every decision he makes today. The first one is called intrinsic value. This is the real worth of a company based on its fundamentals: earnings, dividends, assets, growth potential. Not what the stock price says, not what the news tells you. The actual, honest value of the business itself. Buffett describes it this way. Think of a stock as a business. The market price might swing wildly day to day based on fear and greed, but the intrinsic value moves slowly. It follows reality. And here's the key insight. The market is there to serve you, not to guide you. It offers you prices every single day. You get to decide whether those prices make sense. Most people do the exact opposite. They watch the price, assume it's correct, and then decide whether to buy. Buffett does it backwards. He calculates the intrinsic value first. Then he waits for the market to hand him a bargain. This brings us to the second principle, the margin of safety. Graham taught Buffett that you should only buy a stock when its market price falls significantly below your estimate of its intrinsic value. That gap is your margin of safety. Think of it like buying a house. If you think a home is worth $300,000, you don't pay $300,000. You wait until someone needs to sell fast and you can get it for $210,000. That's your cushion. If you're wrong about the value, the margin of safety absorbs the mistake. In 1962, Buffett applied this exact principle to a textile company called Berkshire Hathaway. He bought shares at $7.62 each. The intrinsic value was higher. The margin of safety was there. He kept buying until he controlled the whole thing. That decision, of course, changed everything. But Buffett didn't just stop at buying cheap companies. The third principle is where things get really interesting. And this is the one that separates him from Graham. Buffett calls it the economic moat. A moat is a wide ditch filled with water that surrounds a castle, making it hard for enemies to attack. In business terms, it's the competitive advantage that protects a company from rivals. It could be a brand so powerful that customers refuse substitutes. It could be a patent portfolio, a network effect where the product becomes more valuable as more people use it, or economies of scale that let the company undercut everyone else's prices. Coca-Cola has a moat. So does Apple. So does your local utility with its regulated monopoly. These businesses don't just make money. They keep making money because competitors can't easily replicate what they do. This is where Buffett evolved beyond Graham. Graham only wanted cheap companies, assets trading below their book value. Buffett realized something crucial. A wonderful company at a fair price beats a terrible company at a cheap price every single time. In 1972, his partner Charlie Munger convinced him to buy See's Candies for $25 million. It was not cheap by Graham's standards, but See's had a brand, a loyal customer base, and pricing power. 40 years later, See's had generated over $1.9 billion in cumulative profit for Berkshire on a $25 million investment. That's the power of a quality business with a moat, held for decades. If this framework is making sense, hit that subscribe button. I put out videos like this every week, and there's plenty more where this came from. Now, for the principle I promised you, the one Buffett says changed everything. Buffett calls it waiting for the fat pitch. Baseball players get 4 balls and 3 strikes before they walk. A fat pitch is a pitch so good, so perfectly in the strike zone that swinging is automatic. You don't wait for it. You don't let it pass. You swing. In investing, most people are swinging at every single pitch. They hear a hot tip on a Tuesday and buy by Wednesday. They read a headline and react. They check their portfolio daily and move money in and out constantly. Buffett sits in the on-deck circle for years if he has to. He watches opportunity after opportunity pass by. He waits. And when a truly extraordinary business trades at a price that gives him a wide margin of safety, that's when he swings. In 1987, the market crashed on Black Monday. $840 million in market value vanished in a single day. People panicked. Buffett saw something different. He saw high-quality businesses on sale. He started buying Coca-Cola stock the next year. By 1998, that investment was worth over $10 billion. He did the same thing in 2008 during the financial crisis. While the rest of the world was selling everything, Buffett was writing checks. He bought Goldman Sachs preferred shares yielding 10%. He invested $5 billion dollars in Goldman. By 2013, he had made nearly $15 billion dollars on that deal alone. The fat pitch works because most opportunities in the market are just okay. They're not terrible, but they're not extraordinary either. The difference between a good investor and a legendary one is the discipline to wait for the truly extraordinary opportunity, and then the conviction to bet big when it arrives. Buffett has said publicly that his best investments are spaced years apart. Some decades, he makes almost nothing. Then the right moment hits, and he deploys billions. His first purchase of Apple stock in 2016 came after years of watching the company build its ecosystem. He didn't fully understand iPhones in 2010. By 2016, he understood the ecosystem, the brand loyalty, the pricing power. He bought roughly 1 billion shares. By 2023, that position was worth over $156 billion, making it the largest holding in Berkshire's portfolio. That's the fat pitch. That's what patience looks like when it works. So here's what you've got. 3 interlocking principles that Buffett has used for 6 decades. Intrinsic value tells you what a business is actually worth. The margin of safety gives you a cushion when you're wrong. The economic moat identifies businesses that will keep generating cash for years or decades. And patience, waiting for the fat pitch, ensures you only bet big when the odds are overwhelmingly in your favor. You don't need a finance degree. You don't need a trust fund. You need the discipline to stop reacting to every headline, the humility to admit you don't know what the market will do next, and the willingness to wait when nothing exceptional is on the table. Buffett is 94 years old as of 2025. He's been practicing these principles since the 1950s. He's now one of the wealthiest people who ever lived. The evidence is kind of hard to argue with. If this video gave you something useful, share it with someone who's always checking their stock app. Hit subscribe and come back next week. I've got another framework that might just change how you think about money. Thanks for watching. I'll see you then.